Now, there are some pockets of real misery on the JSE at the moment, with a number of sectors facing crisis or calamities of some type or another. Share prices have been hammered in the platinum, poultry and construction space, to name just a few. So are there any of these valuations persuading investment managers to dig into their pockets and invest? Roger Williams from Centaur Asset Management joins us in studio to share his views. And you have already said that you haven't been buying much of late. Does that mean that that is indicative of your view of the market at the moment?
Yeah, listen, I think it's over 4 years since we bottomed post 2008. We had a dip in March 2009. And values have become quite stretched. Bond rates are extremely low. They're below the 10-year bond rates, below the last 10-year inflation rates. So it shows you how low bond rates are. And I think the economy is quite sluggish, particularly on the primary side. Really, mining and export industries are not really doing that well. So it's just, I'm not sure how long this bull market can last in the face of a slowing economy.
Roger, we've seen some really bad, really pockets of misery. First of all, the platinum mining sector. I think that's probably the place to start considering what's still going on at the moment.
Yes.
Obviously hasn't persuaded you to invest at this point. How low do prices need to go before you're interested?
Well, I mean, it's a very difficult industry, and there's a lot of variables beyond management's control. I don't know if I'd invest at any price. It's much like the gold mines. The gold mines, despite a gold price which is up over 4 times in the last decade, have not performed. They've actually come off. And I think platinum's facing a lot of the same issues. The biggest problem are really their costs and labor issues. And also platinum is not the metal it used to be. I think there's thrifting, so people are using less. There's substitution into palladium, and there's also recycling. So the demand outlook for platinum is not that great. And then the costs, the massive cost pressures on them, and labor is another issue just over and above that. And I still don't think they look great value. I'll be very nervous. I don't know if you can really consider them an investment.
Before we ask you whether you're finding any value in the other sectors that have been hard hit, what are you finding attractive at the moment? Let's put it to you.
Listen, I have to be honest, I'm not finding...
There's nothing out there that...
I'm really struggling. I have to admit, to deploy new money, I have been getting inflows. Some of my core holdings I've just topped up. I still like Rand Merchant Bank holdings. But it has moved up dramatically over the last 2 years, more than doubling. So the value is not as compelling. The one share I have bought over the last couple months, but it has moved up, is Renit. That's a holding company of British American Tobacco, an investment trust. It was trading at around a 30% discount to its add-up value. And I think part of the reason is there quite heavy management fees on that. But I think Johan Rupert is probably the best businessman that South Africa's ever produced. He really founded Richemont, which is one of the top 5 market cap companies in South Africa. And buying that company on a 30% discount, with him really steering the ship, I think that's, it's a reasonable bet. So I have put in quite a big holding in my portfolios in that one.
Roger, it seems it's a investment, the holding company, but the strategy behind it is going to take some time to roll out, essentially.
Yes.
Johan's put a slice of British American Tobacco in that. Is that literally just the cash cow to milk to make the other investments he's been doing with Reinet?
Yeah, I think the strategy is I think about 80% of the value, I stand to be corrected, is British American Tobacco. And he sees that as a good long-term investment. And if anything beats that hurdle rate, which may be 8 or 10% per annum in euros, then he'll replace that. And that really makes sense. To build up a good long-term investment portfolio, you can't just jump in and buy. It can take years to really accumulate a good portfolio of assets. And I'm comfortable with that strategy.
Let's talk about those construction stocks and why they aren't jumping out at you.
Yeah. The World Cup produced a tremendous boom in construction stocks. And prior to the World Cup, most of the companies were really producing operating margins of about 2.5%. The only exception was Wilson Bailey, which had superior margins. And really, I think it's due to better management within that company. But Marion Roberts, Grinica LTA or Avenge, the construction sector had about 2 to 3% margins. And running up to the World Cup, the margins actually went up to 7%, and the market thought these were sustainable. And what's really happened is the margins have reverted back to those historic levels. I think they'll probably hang around these levels. But construction's, in my opinion, a very, very difficult business. You're not selling a product year in, year out. Every contract has to be tendered for, and there's risks. There's labor risks, there's pricing risks. A very difficult business. I think it should be at a radical discount to the market, and that's where it's kind of manifesting those. So even though they have come off a lot, I think they're more approaching fair value than really opportunities.
It's obviously a very cyclical business, and obviously the argument is that we've had 4 years of misery now, or 3 years of misery post the World Cup because of everyone, the surplus capacity that was in place after the World Cup hasn't been put to use in the country, and yet we still have a government that's very intent on deploying this National Planning Commission and the plans of these strategic infrastructure projects around the country. That's still not enough to persuade you that there might be some good weather on the horizon, so to speak.
Yeah, I think the plans of government are great, but the reality is we're running a fiscal deficit over 5%. If you take guarantees and kind of off-balance sheet liabilities, maybe it's closer to 6%. There's absolutely no funding capacity from the government to finance infrastructure. And what they've tried to do is really through tolls and Eskom, which is paying its way, but there's a lot of resistance from the public. Particularly you can see in tolls, they don't want to pay essentially what is an additional tax. And that is really stalling the whole process. The government doesn't have the money. All the money is really going into social grants, wages. There's no money for infrastructure. So I think it's really pie in the sky to expect massive spend when we're facing this big fiscal deficit problem.
Generally, from a macroeconomic perspective, are you very concerned about the South African situation?
Yes, I think there's been the trouble with South Africa is really our current account deficit is currently over 6%. The weaker gold price, weaker platinum price is not going to help. The closure of many deep level mines is not going to help, and that's a massive risk. I think the government's got a bit complacent. That is a very metric that should be monitored, and I think they assume that our bonds are attractive and foreigners are going to fund us continually. If they take flight and stop funding us, stop buying our bonds, there's a major issue. And really the only way we can really get that more into balance is by contracting the domestic economy, reducing imports, and that may entail raising interest rates, which would be a very negative scenario for domestic stocks, but a good scenario for offshore listed stocks. And that's part of the reason why I'm very cautious on buying domestic stocks, even though they may look reasonable value. Some of the banks aren't looking that expensive, but if interest rates go up 5-6%, they'll halve. Whereas something like British American Tobacco, notwithstanding its exceptional performance, will still do very well. So this it's a scenario which could play out. I'm not saying it's going to happen, but it would be very bad for domestic stocks.
You've got, I know you have the ability obviously to invest offshore. Just tell us how attractive, we've seen the American market having a fantastic run with the S&P meeting new highs every day. Do you see value in the US market at this point? Because it seems to be the first economy to emerge in the developed world out of this I guess, recession and financial crisis we've had.
Yeah, I don't follow the US market that closely, so I can't comment on the value, but with interest rates where they are, I think 10-year rates are at about 1.8%. Equities will probably hold up. I think it's not only about value, it's about relative value. And when bond rates are so low, as they are in South Africa, it really pushes the flow of funds into equities. And I think that's going to remain for the foreseeable future. So it's going to underpin the market, and it possibly can go higher.
Roger, just in terms of the international front and offshore equities at the moment,
Yes.
anything catching your eye there?
No, not really. I mean, I've been focusing more on the local market, and yeah, it's not my. I do follow some stocks, but
you prefer to stay South Africa focused?
Yes.
Roger, thanks. Final question from you.
Yeah, I just wanted to see fixed income. You run some balanced funds. Obviously, the 10-year yield at an all-time low, as we mentioned. Has the degree of interest in our bonds surprised you regarding the amount of foreigners that have been buying the bonds?
Yeah, I think if you look at precedents around the world, this has happened quite, often before, and it doesn't mean it's a great investment. It's going to continue. Greek bonds were very strong prior to their collapse, and junk bonds or low quality bonds have also been very strong. So I'm not sure people are. I think it's really a rush to yield for yield, and they maybe not looking carefully enough at the risk metrics. I think there is risk, particularly if the rand weakens, that bonds could move out quite a lot.